If Fannie and Freddie buy up these mortgage bonds, I get supply, demand, you buy it up, what happens in terms of rates, but how would it work and what impact would it really have?
Hi, thanks for having me on today. Yeah, I've been looking at this, pretty hard in the last 24 hours or so. It's not entirely unexpected. We've been observing that the GSEs had actually been adding agency mortgage-backed securities already since July or so, to the tune of, I would guess, about $40 billion.
So buying up.
They've been buying them anyway. So this should be another $200 billion, 5 times that. And, I will say that the spread impact has been fairly substantial so far. It's not just about them buying. It's also that volatility has come down. But combined, spreads are about 40 basis points, were about, before this announcement, about 40 basis points tighter. And, of course, we've seen mortgage rates come down from 7% earlier this year after the tariff ruling to more like, low sixes, 6.16 for conventional 30 years, below sixes for
So it
Ginnie
works?
Maes. Well, again, it's mostly about volatility, actually, which has also come down. And that's partly because people think that the Federal Reserve is actually more on a glide path. So, this throws some wrinkles in the equation. For instance, now, if higher demand for homes without more supply means that home prices go up, that could boost inflation. So there could be a lot of offsetting factors, both from affordability as well as mortgage rates.
Yeah, I'm glad you brought that up because a big part of our conversation, this is all about the president trying to make homes more affordable for Americans.
Right.
And if we think about it from the perspective of what's happened this week, what he said publicly about not wanting institutional investors to buy single-family homes, none of that necessarily addresses the supply side of this, which a lot of economists argue this is the issue. It's a zoning issue. This is a local issue. The question I have for you is, what does Fannie and Freddie end up doing with these assets? And how long do they have them on their balance sheets?
I mean, this is actually a pretty small drop in the bucket, both relative to what they used to own.
For now, though, maybe they could do more.
Well, they're statutorily capped because of what happened in 2008 after they got taken into conservatorship. So they've been working really hard to decrease the size of their portfolios, and now, of course, they're beginning to grow them again. So they're kind of capped as to about $200 billion. To put that in context, the Federal Reserve, after COVID hit and people were worried about housing and financial markets freezing up, bought almost $600 billion in 2 months. So just to put that in context, now that had a pretty big spread tightening effect, and it lowered rates because they were buying treasuries at the same time. In contrast, the GSEs probably are going to have to hedge their mortgage-backed security holdings, so they'll probably be selling rates into the market at the same time they're buying mortgage-backed securities. So this is about spread tightening.
Yeah.
And spreads have already tightened basically to equilibrium levels. So they can tighten a little bit more in the short run, but you might also have relative value investors selling at the same time. Active money managers are all overweighted. I could see them taking their weights down to zero. That could offset a lot of the gains from spread tightening.
So bottom line, there are roughly $9 trillion worth of agency mortgage bonds outstanding. It's a massive market. So bottom line, just 30 seconds, more bark than bite in terms of what we're getting from the president rather than a substantial policy that would address affordability.
They will be taking out a substantial amount of current supply, so rates may come down a little bit.
Okay.
But even a 25 basis point decrease in rates isn't going to move the needle from an affordability standpoint, especially if home prices rise.